What if I told you that one single source has shaped the minds of some of the world's absolute most successful wealth builders for over 7 decades? Seriously, Warren Buffett, who is arguably the greatest investor of our time, credits his incredible success to Benjamin Graham, his ultimate financial mentor. And Buffett doesn't just call his work, a good read. He literally calls it the best book on investing ever written. I mean, wow, that is some serious high praise. But here's the kicker. The thing that makes this so fascinating. This was published way back in 1949. That's long before zero-commission trading apps, way before crypto, and well before all this algorithm-driven market panic we see today. These wealth-building principles, they were already established. And they offer this proven, almost stoic contrast to the frantic noise of modern internet trading culture. We're talking about timeless strategies for actual wealth creation. So welcome to The Explainer. Today, we're basically taking a masterclass on Benjamin Graham's legendary philosophy from The Intelligent Investor. We're going to unlearn some toxic emotional habits and figure out how to adopt a truly calculated, bulletproof mindset. Okay, let's dive right in. Here is our roadmap for today. First, the ultimate investing playbook. Then, dealing with Mr. Market. Third, the margin of safety. Fourth, investor versus speculator. And finally, we'll answer the big question. Is this timeless wisdom or is it outdated? All right, Section 1, the ultimate investing playbook. So the foundational premise of Graham's entire playbook is a complete, total shift away from speculation and gambling. Honestly, investing is not about getting rich quickly. It's really about protecting your money, managing your risk, and steadily building wealth over time. This whole philosophy relies on discipline, patience, and just rational decision-making, rather than chasing those fast, exciting, but super risky gains in the stock market. The core goal here is to help everyday, ordinary people become intelligent investors instead of reactive, emotional traders. It's a marathon, not a sprint. Moving on to Section 2, dealing with Mr. Market. Okay, I want you to imagine for a second that you own a business, and you have this really unpredictable kind of manic partner named Mr. Market. Every single day, without fail, he comes to you and offers to either buy your share of the business or sell you his share. But here's the catch. His daily mood swings completely dictate his prices. On his highly optimistic days, he's absolutely thrilled about the future and offers you a crazy high price. But on his depressed days, he sees nothing but doom and gloom, and he offers you a ridiculously low price. So what's the crucial mentor lesson here? Do not let the market's emotions control your decisions. An intelligent investor looks at Mr. Market's wild mood swings not as panic-inducing alerts, but as huge opportunities. Think about it. When he's depressed and offering ridiculously low prices, well, you might want to step in and buy. When he's wildly optimistic and offering crazy high prices, you might want to sell. You're using his fluctuations to your advantage. And absolutely never, and I mean never, treat his daily prices as instructions for what your business is actually worth. Which brings us to Section 3, the margin of safety. Now, once you've learned to ignore Mr. Market's emotional roller coaster, you need a rock-solid strategy. And the absolute foundation of value investing is this concept called the margin of safety. Basically, it's the practice of buying assets below their intrinsic value. And by intrinsic value, I mean looking at a company's actual earnings, its physical assets, and its cash flow, not just staring at a flashing green or red stock ticker. It's literally just like buying a high-quality, premium product at a massive discount. You know what it's truly worth, but because Mr. Market is having a bad, depressed day, you get to buy it for significantly less. But why is getting this discount so absolutely vital? Well, let's face it, we are human. In our calculations about a company's true worth, they're going to be slightly wrong sometimes. If you buy at a steep discount, that gap between the price you actually paid and the true value of the business acts as a safety cushion. It helps protect you from major losses, guarding your hard-earned capital against unforeseen market events and, our own inevitable mistakes. All right, Section 4, investor versus speculator. Let's do a little honest self-reflection right now. Look at the screen. How does a truly disciplined mindset operate compared to someone who's basically just treating the market like a casino? An investor studies carefully, fiercely protects their capital above everything else, and seeks reasonable, steady returns. A speculator, on the other hand, is out there chasing the latest hot trends, relying on guessing and bold predictions, and taking excessive risks, hoping for some massive payout. Graham's philosophy is a constant challenge for us to recognize exactly which side of this table we fall on, and to course correct immediately if we're just out there speculating. But why do so many smart people slip into speculating? It boils down to two things: fear and greed. According to Graham, your biggest enemy in investing is often looking right back at you in the mirror. Fear causes people to panic and sell during market crashes, which ironically is right when prices are lowest and bargains are everywhere. And greed? Greed causes people to buy into massive, hype-driven market bubbles, right when prices are dangerously high. Giving in to these emotions just leads to disastrous financial mistakes. Remember, the market rewards patience way, way more than it rewards excitement.
And finally, Section 5, timeless wisdom or outdated.
So let's be totally objective here. The core strengths of this philosophy, the principles of risk management, ignoring market noise, are completely timeless. It teaches critical long-term thinking, focusing heavily on avoiding mistakes rather than just swinging for the fences to chase extraordinary gains. These are proven ideas used by generations of the most successful investors on Earth. But on the flip side, we have to be honest. Because it was written decades ago, some of the specific company examples are definitely outdated. It can feel a bit dry and technical for beginners, and certain accounting discussions are pretty complex. You definitely need some patience and very careful reading to get through it. So who actually benefits the most from this masterclass? Well, it is absolutely ideal for beginner investors wanting to start out with the right habits, long-term wealth builders, personal finance learners, and really any stock market enthusiast who wants a rock-solid foundation. But let me be explicitly clear here. If you are looking for quick flip trading strategies or get-rich-quick crypto methods, this philosophy is for sure not suitable for you. Taking everything into account, the source material earns an exceptionally high rating from us, a 9.5 out of 10. While the technical accounting definitely shows its age, the core focus on developing the unshakable mindset needed to protect and grow your wealth over a lifetime, that remains incredibly powerful. It absolutely cements its status as a timeless classic that every single serious investor should study at least once. I want to conclude our explainer today by leaving you with this one provocative question. Are you an investor or a speculator? Really take a hard look at your financial habits today. Are you managing risk like a disciplined business owner? Or are you letting Mr. Market's crazy daily moods dictate your financial future? I really hope this session has empowered you to take control, find your own margin of safety, and approach your wealth with true intelligence. Keep learning, keep focusing on those fundamentals, and I will see you in our next explainer.